Hey guys, I hope you and your families are doing well. The trading concepts that I'm going to be sharing with you in this new video series have taken me many years to refine and seek continual perfection. Like you as a trader, I'm always trying to learn, grow, develop and improve. So if I can help you in some small way along your trading journey, that'll really make me happy. So what we're going to do in this video is going to be a deep dive in terms of tape reading, really getting you to understand what are you doing, why are you doing it, and when are you doing it within the confines of a strategy, within the confines of your process. So really thinking about things from an identification standpoint, initially controlling the risk mitigation, and then optimizing the profits, both thinking in terms of monetary gain but also the efficiency of the gain as well. So as I said, this ain't going to be a fluffy woo-woo video. This is going to be a deep dive, and by the end of the video I actually hope that you're a different trader. You see the charts differently. MarketSmith are today's video sponsor. There is a discounted trial available in the comments below. Okay guys, so let's just start off with a very high level overview of the trade thus far. So this will encompass the four parts of every single trade: identify, control, mitigate and optimize, and then we're going to work through in a logical way through those four parts of every single trade and really deconstruct it, and then you can understand why I'm doing what I'm doing and when I'm doing it within the confines of that strategy. So the initial entry is a pullback to the 50-day SMA, which is the purple line that you see on the charts. It puts in a shakeout demand tail. The initial stop loss is placed down here, 313.65, so that's 2.27% risk. I then free roll the trade 3 days into it. I then exit part of the position here on a close below the 10, and then no close below the 21-day EMA thus far, so still in with a quarter of the position. That's the high level overview of identify, control, mitigate and optimize. But what I want to do in these videos is really break it down, each of those component parts, so you really understand it. So we're not even going to be looking at this base yet. We've got to go back in time. So let's begin right at the start of the identification. So a lot of my trading is I'm trying to follow institutional footprints. So this is all about large operators in the market. I'm trying to follow their footprints. I'm going, okay, what are the bigger boys and girls up to? Are institutions supporting this stock? Are they not supporting this stock? And for me, I'm much more focused on those O'Neill, Can Slim, true market leader stocks. Ideally, there's a lot of institutional liquidity, big earnings, big sales, big estimates involved in a new revolutionary technology, meta, such as artificial intelligence, right? So let's get into it, okay? I really hope this video is going to change how you view the charts, your kind of tape reading skills, right? So we can see here, okay, this here on the earnings, what do you think bigger boys and girls are doing here on the earnings? Does it look like they're accumulating? Does it look like they're distributing? For me, net, it looks like they're distributing. You have a very large gap down here. The gap down is about 24%. Also, you can see there's very high relative volume, and the stock is hitting 52-week lows. This is what institutions distributing a stock looks like. Look at this. See the earnings reaction here? This is not accumulation. This is distribution coming through, okay? This is not constructive action to see. But then what I'm doing in a lot of my trading is trying to identify change of character, identify turning points. So where is the change of character on this chart? Where does it start sticking out to you? It's this here on the earnings, isn't it? Look at the high relative volume coming through. Look at the gap up on the earnings. Now it's above all key moving averages. If we bring it up here and we just take a rough average, we've got 150 million shares traded on this day, and if we took an average price of 185, which is kind of like the mid-range of the bar there, that's over $27.5 billion worth of stock traded on that day. Let me just emphasize that. $27.5 billion worth of stock traded on this earnings gap up. What do you think the bigger boys and girls are doing? Suddenly looks like a change of character. Suddenly it looks like they're starting to accumulate. So then we're looking for certain things. We're looking for certain characteristics. Now ideally we'd like to see the stock generally staying above all key moving averages. So the black line is the 10-day EMA, the blue line is the 21-day EMA, and the purple line is going to be the 50-period simple moving average. Now for Meta, it's a much bigger boy. So the two key moving averages that I'm going to be paying attention to are the electric blue line and the purple line. So 21-day EMA and the 50 SMA. The black line, the 10-day EMA, is probably going to be too quick for Meta, I would be thinking. So what am I then looking for? Well, generally I'm looking for the stock to be trending up, making higher highs, higher lows, higher highs, higher lows, generally staying above those moving averages. You'd like to see increasing volume coming through on the rallies and decreasing volume coming through on the pullbacks. Why? Because it just says there's more buying coming through when the stock is moving up. So if you see this here, see this, look at the volume increasing on this rally here, and then when it's decreasing like this, when the stock is pulling back into those moving averages, look how the volume is generally drying up here. But it's not all about there's an increase in volume coming through when the stock is going up and there's decreasing volume coming through when the stock is pulling back. A lot of it is trying to understand the characteristics of the candlesticks as well. So this is where we're going to start getting into okay, understanding supply and demand a lot better. So let's just do this, and let's have a blue zone and let's have like a pink zone, okay? So ideally you want to see lessening volume coming through on pullbacks like this. Yeah, the volume is drying up here, and in this blue box here, you have these, they're tight looking candlesticks, right? If you look at the real bodies, so that's the difference of where the open is to the closes, the overall range of the day. Generally the ranges are pretty tight. The real bodies are quite tight, the overall ranges of the days are quite tight, and the volume is below this black line here, which is the 30 bar average, which was absolutely fine. You can use 27.5 days, 31 and it doesn't matter, okay? 30-day average volume works fine for me in the purposes that I'm using it for. So if you then look at here, these multiple tight candlesticks and low relative volume is a sign that there isn't that much supply. There's not that much selling. Certainly if the stock then holds in vicinities that you would like it to hold in. So with Meta, that's going to be say 21-day EMA, potentially the 50-day as well. And then on the rallies here, you see this? These candlesticks that you see coming through, these are widespread candlesticks. If you look at the difference, see the real bodies here, the real bodies are pretty tight on a lot of these bars. See that? So this is looking like there's not much supply, there's absorption of supply, the volume is drying up. But as the stock then rallies here, okay, you have what I call bullet. That's supposed to be an arrow, and that's a bad arrow, isn't it? Why don't I just do the arrow? There we go, like that. And let's even make it blue. There we go. Okay, so you have here coming through, you have an increase in volume. See how the volume's going above the 30 bar average, and you have widespread candlesticks. The overall spreads are wider. This is actually a gap up here. Gaps, opens on the low of the bar, pushes up, opens near the low, goes out on the high, opens near the low, goes out on the high. So what is this telling us? For me, this is what I call bullish synchronicity. There's a synchronicity between the positive price action and the volume is confirming that as well. There's a lot of buying coming through here. We can visually see it in terms of the dollar volume. We can see it with the increasing volume. We can see it with the widening of the spreads. And then as we pull back in here, note the multiple tight candlesticks and look how the volume dries up. So it's a similar point. There's absorption of supply. There's limited supply coming to the market. So this is what it means when you want to see increasing volume coming from the rallies and then decreasing volume coming from the pullbacks. It's basically indicating there is more buying, there is more demand than there is supply, than there is selling. But it's about tape reading the candlesticks as well in the context of where are you seeing it. Ideally, the stock is in an uptrend, making higher highs, higher lows, generally speaking, holding above certain moving averages that you think are appropriate for the stock. Most stocks, it's going to be 21-day EMA and the 50-day simple period moving average. So we have a bit of a turning point here, right? So visually, if we start breaking down on the chart and we start looking at this, if we make this like a big pink zone here, and then we go and make this say like a big red zone over here, do you see how the stock is now starting to act differently? And the reason it's acting differently is because of how institutions are treating the stock. The institutions from the red zone to now the pink zone are treating the stock differently. This is distribution. This is accumulation. So you're visually trying to interpret, and again, you're like a detective here, okay? You're trying to infer, okay, what am I seeing here? From a price, from a volume perspective, okay, the relative strength line is turning up. Was there something material that happened on the earnings? Was there potentially a catalyst that happened? Has the company just blown estimates out of order? Have they raised full year guide? Has something happened there on the earnings? Because the stock's now being treated differently. So if you start viewing a chart like this, that you can actually start seeing, okay, I can visually see distribution. Like, this is the cool thing about learning to tape read. You can visually see distribution. There's certain characteristics that you would associate with distribution. There's certain characteristics that you would associate with accumulation, with absorption of supply. So it's all about really trying to follow institutions, follow the footprints of the institutions. What are they doing? Why are they potentially doing it? Maybe we don't need to know the why. The fact that they are doing it is much more important than the why. We can't take out a clipboard and go and ask Fidelity, JP Morgan, Goldman Sachs, hey, why are you acting a little bit differently now? We can't do that. But visually, we can see their actions. And we know they're going to be involved in Meta. It's obviously a huge stock. Then what do we have here? Okay, well, we have another earnings gap up. Gets a red volume bar, but it's fine. It's just a tight real body. It kind of gaps, and then it's a really tight doji candlestick. Bit of indecision. But for me, the stock is still acting okay. And then on the pullback, are you seeing distributional characteristics? Well, not really. Multiple tight candlesticks. Generally, the volume dries up, and the stock now holds the 10-day EMA. That is a real sign of strength for a stock this size. And then it starts kind of tightening up here. You get these tight candlesticks. Look at the 52-week highs on the relative strength line. Free tool. Search my name in the TradingView indicators. You'll find it here. Jack Corsellis RS line. It works super duper well. This here, okay, now it's starting to act quite well. Higher highs, higher lows, higher highs, higher lows, generally holding the 10-day EMA. Wow, this stock here is really strong. Look at all the 52-week highs. So let's then play this forward a little bit more, okay? because Meta then starts building this large base, and I kind of want to go to where my entry was here, okay? So Meta then starts building this large base. Now there's a change of character on the earnings heading into the base. So again, we want to be aware of these change of characters. So why is this a change of character on the earnings? Shall I actually zoom into it? Let me zoom into it for you guys, okay? So you're trying to spot change characters, both positive, both bullish, okay? So if you think about this one here, okay, there's 60 million shares traded. Let's go and just load up a calculator, okay? There's 60 million shares traded on this day here, and we have an average price, let's say the average price 319, okay, times by 319. So what's the dollar volume of this bar here? It's $19 billion. That's quite a lot. There's $19 billion worth of stock traded on this bar here. And what happens? What's the characteristics? Well, it gaps into this overhead resistance, the prior high, gaps up, gets sold into, closes on the low. Interesting. So it's gapped up, open basically on the high of the day, and as soon as it's opened, it looks like it's begun to get sold into. And the volume is large, and it's on the earnings. So we think, and we know the bigger boys and girls are going to be active here. Volume is probably 2.5 times the 30 bar average, roughly. So this is interesting. Gap up, opens on the high of the bar, gets sold into. Interesting. Potential change of character. Now we'll come on to sell rules a little bit later when we get into the fourth part of the trade, okay, optimizing profits. And you may be like, why are you talking about all of this? Like I thought you were going to talk about your trade, because this is all in the identification process that gets you to the trade. Like you are visually trying to follow institutional footprints. Like you're trying to logically work your way from left to right on a chart. You're trying to follow the footprints. You're trying to decipher, okay, what do I think institutions are doing? Are they distributing this stock? Are they accumulating this stock? How long have they been supporting the stock? Has the stock moved a significant amount? And maybe it's like a 4th or 5th stage base in a phase 2 uptrend. Is it a large base? What am I seeing around the lows of the base? So here is a change of character. So okay, maybe this violates your sell rules, maybe it doesn't. For me it doesn't, and I don't have a position at that time there. Then we start to see a large base building. Now what I'm going to do is just go to where the entry candlestick is. So here we go. We're going to start tape reading this base, okay? One of the first things that I'm drawn to when I look at a base is I want to see the visual size of the base, okay? So big causes tend to lead to big effects. This is a Wyckoff concept of the law of cause and effect. So when I see a big base like this, I'm going, this stock can have a lot of running room to the upside. If you think logically, well, why is that? You've probably heard that term, right? The bigger the base, the higher in space. Have you ever thought why? Has anyone ever told you why? Well, here we go. Again, tape reading is logical. It's extremely logical. Accumulation and distribution is logical. So if you think about it, the bigger the base allows more time for accumulation by large operators. Larger operators have more time to step up and support the stock and take shares off of weak hands. That's how I view it. So if there's greater time for large operators to step in who are going to be holding the stock for a bigger move, so the Fidelities, the JP Morgans of the world, they're looking to hold the stock for a much bigger move. They're not looking to probably sell it after 2 weeks of initiating position. They take quarters to build up their positions. So it allows more time. So this is all about understanding the type of market participants that are going to be involved in the type of stock. This is not a $50 million biotech company with a market cap of $50 billion. This is Meta, for God's sake. Okay, Metas, Nvidias, Teslas of the world, Ubers of the world, whatever they may be. So again, a lot of common sense comes into tape reading, comes into studying the charts. So then what my eye is drawn to is the lows. Okay, the lows are the basis. Now, why would I be interested in the lows? So large operators, the two things they require above everything else is liquidity and perceived value. So then I'm visually looking for signs of accumulation, of absorption of supply, and large operators stepping up and going, thank you very much. We see enough perceived value. We see enough liquidity. We're stepping in here. And when they start stepping in, I think they then tend to step in and support their positions as well. So if we start looking here, you'll see that I've pointed to numerous candlesticks. This one here, this one here, this one here. There's one on the earnings as well, okay? Now, these are what I call shakeout demand tails. This is actually also a gap down reversal bar. If you've watched the blueprint video on the channel, you'll be familiar with that. So as I'm looking around the lows of the base, I'm going, interesting, big base, and then marking the lows every single time is a candlestick that I would associate with accumulation, with absorption of supply. Now, yes, you have a big red volume bar on the earnings, but what's the candlestick? Well, actually, it comes down into the base lows and is a shakeout demand tail. Yes, it gaps down, opens on the low, but then there's a shakeout demand tail, and what happens in subsequent sessions? Stock pops, V-shaped rally. What does that tell me? Big boys and girls stepped up, supported the stock for whatever reason. Now, oftentimes we're not going to know the reason, and people have different reasons why they're doing what they're doing when they are doing it. But we're trying to follow the footprints here, and around the lows we're going gap down reverse bar, shakeout demand tail, shakeout demand tail. Looks to be a shakeout demand tail on the earnings, followed by a V-shaped rally, nice and strong. And then look how it tightens in here, and look how the volume dries up. What's that telling me? What did we learn earlier? about multiple tight candlesticks and low relative volume. Sign of absorption of supply. There's not much supply coming to the market. And then over here where the entry is, it puts in a higher low. Higher lows are structurally bullish and it's pulling back down to the 50-day simple period moving average. Interesting. Now with these larger cap stocks, these mega cap stocks, I'd rather be buying lower in the base, not these kind of base breakouts through the highs. I'd rather be buying lower on in the base. Why? Because that's when I think institutions are going to step up and support the stock. So I want to be buying around the lows when I start to see the change of characters. So there's 3 candlesticks that I really target, and that's variations of what I call trigger bars, gap down reversal bars, and shakeout demand tails. So as Meta is then pulling down here, okay, I see this is a shakeout demand tail. So prior closes here, gaps down, opens here on the 50-day, and then puts in this shakeout demand tail and moves up. Now, why is that important? Because what I'm doing is I'm going, okay, I've seen numerous times, thousands and thousands and thousands of occasions where a leading stock has got supported right on its 50-day moving average. And I'm seeing signs that this is a large base. There's a lot of evidence that large operators are in here. So around the 50-day, I'm looking for one of my optimal entry candlesticks, a shakeout demand tail, a gap down reverse bar, a trigger bar, and I'm seeing it at the 50-day. And the prior stock has hit, there's a prior 52-week high on the relative strength. I'd like to see that as well. So the stock's pulling down here. Now what I'm going to do is take you down to the 15-minute chart, okay? So I really want to go deep here in terms of the tape reading, all right? So do you have to do this? Look at a 15-minute chart? Absolutely not. You don't have to do this, right? But what I use is I use what I call multiple time frame analysis. I'm looking at multiple time frames and I'm trying to dissect, okay, what is happening here? What is going on? So what we can see here now on the 15-minute chart, we're breaking down that shakeout demand tail on the 50-day moving average on the daily chart, and we're now doing it on the 15-minute chart. Okay, this is where we're going deep down the rabbit hole, and we're going to see Alice in Wonderland in a minute. So the prior close is up here around 325. The stock gaps down on the open. Opens here at 317. Sells off for the first 15 minutes or so. But then what do you see? What's the next bar? What bar is this? This right here is a shakeout demand tail. It's a shakeout demand tail. And where is it occurring? Pretty much right on the 50-day moving average, where I'd expect large operators to step up and support the stock. Interesting. So we have a shakeout demand tail that marks the low of the day. Now, we want to develop a Bayesian mentality. So Bayesian mentality is you constantly update your decision-making process when new information becomes available. So when I'm then looking at the session and it's progressing and it's on my radar, I'm waiting to the close. Okay, I then use a buy stop limit order targeting through the prior session's high, but I'm then breaking down the session, deconstructing the session and going, nice, shakeout demand tail in proximity of the 50-day moving average on the daily chart marks the low. Is there any consistency of supply there afterwards? So what did we learn earlier? Multiple tight candlesticks. Do you see the real bodies? Look how tight the real bodies are. Look how tight the real bodies are. Look how tight the real bodies are. And what did you notice about the volume? The volume's drying up. So not only do you have a shakeout demand tail at the 50-day moving average on the daily chart and a leading stock involved heavily in artificial intelligence, you have this shakeout demand tail mark in the low followed by this. And volume drying up. What's that telling you about supply? Are you starting to see the change of character? Footprints of large operators. So we're identifying change of character. What then happens afterwards? You have this nice rally and it does it on pretty low volume. There's an ease of movement to the upside. So if a stock can rally like this, and generally you have some wide spreads coming through like this bar, but certainly this bar, and it does it on average volume or below average volume, there's an ease of movement. I call this bullish ease of movement. You can have bearish ease of movement, but this is bullish ease of movement. Price is easily moving to the upside. It's not taking much buying power to push this stock up. So that's indicating to me there's not that much supply around. Then we pull back down, and what bar do you see marks the low? Interesting, shakeout demand tail. Now what do you also notice? There's not that much volume on it, and it puts in a structural higher low. So we have a higher low, shakeout demand tail on low relative volume below the 30-bar average, marking the low, followed by tight candlesticks on low relative volume, and then a rally on generally low volume into the close, bullish ease of movement. So then when you're deconstructing this and you're looking at this session and you're tape reading it and you're breaking it down and you're understanding things from a supply and demand perspective, you're kind of like, well, that's pretty optimal behavior to see right at the 50-day moving average. Like that to me is signs that institutions are in there. They're supporting the stock, and I'm seeing evidence that there's not much supply coming to the market. Like this is the depth, this is the detail that you have to go into, I think. So now we go back to the daily chart, okay? And then on the daily chart, we've got a really good view there of what was happening intra-session, what was going on during the session. Okay, yes, we have a shakeout demand tail, optimal entry candlestick for me on the 50-day. That's where I'd want to be. Okay, 21-day, 50-day for pullbacks in these large mega cap stocks when I want to be targeting rather than breakouts through base highs. And then when we deconstruct the session, we're seeing some really positive things there. If you understand what it is I'm trying to teach you from a supply and demand perspective, then you'll understand why when you look at the 15-minute chart, that was so positive. Because it's the location and the proximity and the region of where things are happening. It's not just, oh, that happened. Where did it happen? Where did it happen? And then for you operating within the framework, why are you doing what you're doing when you are doing it? Like, there should be nothing random in terms of your trading. Everything has an end. Everything has a means. There's a reason why you're doing it. So for me, I'm then targeting the entry, and I'll just kind of play this forward a little bit. So for me, I'm then targeting the entry. Let's kind of go automatic like that. So I'm targeting the entry through the high of this bar. It takes a couple of days for it to go. My initial stop loss is pretty tight. It's 2.27%. So for me, what I like to do, certainly in these much more liquid stocks, is I like to hit them fairly hard in terms of initial position size. So I like to get in, hit it hard with a nice tight stop, and then free roll it and take the risk out. So what I'm going to do is just drag these down, so you can see a little bit more. So we're working through the process here. So the part that I'm going to talk about now, okay, you can see how we're working through the logical process. There's 4 parts to every single trade. Number 1, identify a high quality setup as per your criteria. This is what we've just been doing. Number 2, control the risk, create an asymmetric risk versus reward trade. Number 3, mitigate the risk. Do you have to mitigate the risk? You don't have to mitigate the risk, but I like mitigating the risk. I like being risk-free, break-even, free-roll the trade. That's how I like to trade. And then number 4 that we'll talk about in a minute is optimizing the profits. What are your selling rules? What are your selling guidelines that you're using to optimize the profits, both in terms of monetary gain, but efficiency of the gain as well? So let's start here. Let's just finish off with the identification process. So I then use a buy stop limit order primarily. I'm targeting it through the high, and the limit is set 0.5% invariably above the high of the shakeout demand tail, the gap down reverse bar, or the trigger bar, whatever it may be. And invariably my stop loss is then a cent below the low of that trigger bar, gap down reverse bar, shakeout demand tail. So in this instance here, my stop loss is a cent below the low of this shakeout demand tail. And oftentimes I'm trying to tie that in with being underneath one or more key moving averages. In this instance here, it's obviously below the 10, below the 21, and below the 50, right? So that's that there. And then I'm thinking about the initial risk relative to the 20-day ADR percentage. Let me just do this like this. So I got filled at, let me just put it in. I got filled at 329.4 like this. Okay, so my initial risk on the trade is 2.27%. So I'm then thinking about my initial risk relative to the 20-day ADR percentage. Ideally, it's less than the 20-day ADR percentage. Sometimes you can, ideally, like on a trigger bar, it's half to 2/3 because the candlestick is much tighter, right? But on a shakeout demand tail, gap down reverse bar, it can be around the 20-day ADR percentage. Sometimes it can be 1.5 times the 20-day ADR percentage. Anything greater than 4 or 5% though is an initial stop. I've really got to justify and think, wow, this is an absolute fantastic trade, fantastic stock, fantastic setup. And I think I could get 5 times, 10 times my initial risk. Like, that's the thought process I'm going through. So on Meta here, I'm going, right, around about a 2.25% initial stop. Do I think there's a realistic chance this stock could move 20%, 10 times the initial stop? Yeah, actually, the stock can trend. It's had a history. Look at this, had a history of trending. So then I'm just going to jump ahead to the optimizing profits, right? Because everything kind of flows into each other. Everything is kind of integrated within its own respect. So then I'm looking at Meta and trying to understand the behavior, the character of the stock. Okay, if Meta is going to break out, how far do I think Meta could go? Well, I look at the character of the stock. Okay, how far could Meta go before it closes below its 21? 24%. Okay, interesting. From here, if buying it off the 21, how far could it go before it closes below its 21-day EMA? Let's just get a reading on here. Goes up 22%. So is there a realistic possibility that Meta could go up 20%, kind of 10 times the initial stop loss before it closes below its 21? Well, the character of the stock would indicate yes. Okay, that's favorable. If it just does this and chops around all over the place, I'm going to have absolutely no interest in the stock, because from that 4th part of the trade, optimizing profits, where the trade management and your selling rules, your selling guidelines kick in, it's going to be a nightmare. And it's okay to put a stock in the too difficult part. To just go, the stock is not going to trend as I want it to trend. I don't have to play. Like, you have the choice. It's like Warren Buffett. And as he said, just waiting for the golden pitch. You decide. But understand what you're doing, why you're doing it, when you're doing it, within the confines of a strategy, within the confines of your process. Nothing should be random. You shouldn't randomly be trying to like, I'm just going to buy it here because on the 1-minute chart I saw a shakeout demand tail. Well, is that in your process? Like, really write your process down. Be able to explain it to people very, very quickly. But here I want to go. So that's the identification part basically done. The controlling risk part done. So then the risk mitigation, right? So you may be like, well, why did you sell half of your position at 324.12? Let me just go and put some fib tools on this, right? So here, this is what I like to do. So this is what I call active risk mitigation. So as the stock starts moving out here, I have open risk on the trade. Now, with these larger mega cap stocks in terms of position size, I'm going to push it a lot harder, certainly if it's a nice tight stop as well. So then what I want to do is I want to get the risk out. So as soon as I have a prudent opportunity to free roll the position, I'm going to free roll the position. Okay, so what I do here is I can just adjust my stop loss up as the stock starts getting out. I can adjust my stop loss up and then move my stop loss from 313.65 basically to the low of that day there. So I'm still underneath the 50, and as the stock's starting to get out, well, I now don't want to see it turn around because there's a really bullish bar on the 1 hour chart coming from the session from memory. I then don't want to see it undercut. So for me then at the end of the session, I've still got half my position on. As I said, I push it in terms of the position size on this one because it's a nice liquid stock. It's a nice tight stop loss as well on it. So then what I can do is I can get in, hit it hard, take the risk out of the trade, and then see how far the stock wants to trend. And then that's when the selling rules, selling guidelines kick in. So I've covered it in the blueprint video. You can go and see about free rolling levels, risk mitigation, and all that. So now I'm in. So 3 days in. Okay, I've got half my position on, but I'm now risk-free on the trade. Now I want to see if the stock can go on a big trend. So for me, I'm then trying to ride the 10-day EMA and the 21-day EMA. Maybe keep some back for the 50-day moving average. That's how I want to be treating Meta. So you can see here, right? We can see some nice bullish bars, and then what I'm doing is I'm assessing the pullback. So look at this here. You see how it's tight candlesticks. It's a little shakeout demand tail staying above 10-day EMA. Here, this is where I exit part of the position. So I take off a quarter of the position here. Why? Because it closes below the 10-day EMA, and I actually made a mistake 2 bars later, which I'll explain to you, okay? So I take off a quarter of the position here. Why? It closes below the 10-day EMA. You have back-to-back red bars coming through. The volume pops a little bit. So yes, there's a shakeout demand tail. In hindsight, could I have moved, instead of selling the quarter there, could I have maybe put my stop loss on quarter of the position underneath that bar and said turn around and go? Yeah, I could have, but actually I thought the stock was maybe going to pull back down a little bit further. Potentially I'd have a spot to add. I did have a spot to add, and I didn't add to the position. This is something that I could have done better on the trade. Let me actually just go and take you through this bar here, okay? I'm going to show you this on the 1 hour chart. So I'm going to drop it down onto the 1 hour chart, and it's this bar here. So it's, where is it happening? It's an inside bar pretty much. It's not quite an inside bar, but it's very close. Inside bar, I'm going to say, on low relative volume, sitting on the 21-day EMA after you actually get this nice shakeout demand tail, and the stock's putting in a nice higher low. The RS line is turning back up. Let me go show you this on the 1 hour chart, okay? So this is what I should have added to the position. So let me go back, okay? So what we can see here is, again, a turning point, right? So here triggers a lot of stop losses, moves intraday below the 21-day EMA. That's where a lot of, and the 10-day EMA, that's where a lot of people are going to have their stops. But then what do you see? Okay, no consistency of supply. These shakeout demand tails come back in, sign of absorption of supply, little supply coming to the market, and then look at the tightness. Tight, and look how the volume dries up in the last session, and break down the final session. So tightness in price, low relative volume tells you there's not much supply. There's not that much selling coming to the market. So what I should have done there is targeted the position back. So potentially adding, say, half the position back, certainly the quarter that I took off, I should have added it back through the high of this bar, stop loss underneath the low. So what I should have done here. Okay, I should have done that about 1.5% initial risk on the add back. I should have been aggressive there. Either put a quarter of the position back on, potentially half the position back on, and been aggressive there. I didn't do that. That's something that I should have done better, actually, when I look back on this trade. I should have done that. I didn't do that. Can't exactly tell you why I shouldn't have done that, but I should have done that. So anyway, the stock then starts progressing. That's a bar that I should have added, so let me keep that circled there. And then what do we see? Well, we generally start to see increasing volume coming from the rallies. The stock starts hitting 52-week highs, which is great. And then on the pullbacks, we're seeing evidence of absorption of supply. Okay, look at this. Shakeout demand tail underneath the 10, goes out on the high. Low volume. What does that tell me? There's not that much supply coming to the market, and the stock is going high, 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 low, high, 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 low, and staying above the moving averages. So this is how we progress throughout the trade. We go, okay, let's identify a high quality setup as per our criteria. Let's initially control the risk, create asymmetric risk first of all trading opportunities. Let's look to mitigate that risk. Now, maybe that's free rolling off the initial stop loss. Maybe there's a prudent opportunity to bump the stop loss up when the stock starts getting out. Okay, I can now sell half the position, a third of the position, a quarter of a position, whatever it may be. I free rolled the trade. I'm now risk free. Okay, how far can the stock go? Can I ride it? Now, this is where the stock could go 5%, 50%, 500%, somewhat unlikely for Meta. But this is then thinking about, okay, how far is the stock going to go? I have no idea. I can look back at history and go, okay, well, it's kind of reasonable to expect it may be able to go up this percentage before it closes below this moving averages, because I've gone back and I've studied the stock over the last 3 years. This is kind of ballpark what I'm expecting. Mentally helps prepare me as well, because there's going to come a time where I'm going to need to sell the stock. So mentally, I'm then prepared to do it whenever I need to do it. I'm waiting for the market to tell me. So as Livermore said, the market will give you clues of when to get in, the market will give you clues of when to get out. So now we're in the fourth part of the trade. We're in the optimizing profit. I've studied the previous action of the stock. I have a rough indication of how far I may think this stock could go. I'm looking for change of characters, negative change of characters, and positive change of characters as well, like this shakeout demand tail. Remember, this shakeout demand tail intraday didn't look like that. It looked like this. It looked like that bar there. But by the close, it doesn't. It looks like a shakeout demand tail. So your detective work, the way you're kind of inferring what's going on from a supply and demand perspective, if you see that bar closing below the 10-day EMA, or you see that bar, your interpretation from a supply and demand perspective is going to be very different. So this is that Bayesian mentality. As you get new information, you update your decision-making process. And the market will give you new information second by second if you want it. Day by day if you want it, week by week if you want it. You decide how much information you want. You decide how granular you want to go. Do you want to go right down to a 1 minute chart? If you're a swing trader off the daily chart, you probably don't need to go that low, do you? But actually, if you're a swing trader primarily using the daily chart, utilizing, say, the weekly chart, the monthly chart, so being aware of longer term trends, and then the daily chart, potentially you're dropping it down onto the 1 hour chart, maybe you're using the 15-minute chart as well, when you're then looking at, okay, I think I've seen an optimal entry candlestick, a trigger bar, shakeout demand tail, gap down, reverse bar. You then drop it down, you take a look on the 1 hour chart, yeah, constructive, like it, I'm seeing nice action there. Maybe you take a look on the 15-minute chart as well, just get a little bit of a better view. Do you need to go to the 1 minute chart? Probably not, right? It's going to be unnecessary for how you're managing it. But then Meta here, okay? So Meta is then heading into the earnings. So again, what I'm then doing here, do you see how we've gone all through here? Like this is how I think you do it at a really, really, really high level, like a really high level. Do you see how we're just following the story? We're following the institutional footprints. So then as we head into the earnings, okay, I've got part of my position left. I've got a quarter of position left. Had I been able to be more aggressive here and add back to the position, I'd have more going into the earnings, which would be tickety-boo, but hindsight's 20/20, right? So as we then head into the earnings, you get this volume pop, but actually it's nearly an inside bar. And it's kind of like a doji. There's a little kind of supply shoot there, but that actually tells me back-to-back supply shoots holding above the 10 femoral bodies. Willing buyers are there. Like, think about that. Little supply shoot. So price is trying to go up, sellers are bringing it back down. But if this was institutions legging it, rushing for the exits before the earnings, would you expect to see that action? And everything that we've covered to this point. Okay, if we think institutions are getting involved here, there's a real change of character, there's a big base with a lot of accumulation characteristics, and then the quality of the uptrend is fantastic. Higher highs, higher lows, higher highs, higher lows, staying above generally the 21 and the 10-day EMA, 52-week highs all over the place, volume generally drying up on pullbacks. Are you seeing institutional distribution when you look over the last year? I'm not seeing it. I'm holding into the earnings. Now, had I not have had a decent profit cushion, I'd be looking at implied volatility moves and thinking about it that way as well. Okay, have I got a profit cushion greater than the implied volatility move on the earnings? But here is a decent profit cushion. Heading into it, it's around about 20, low 20%, something like that, like 23% or something. And I'm not seeing evidence of large operators exiting. I'm going to hold into the earnings. I think they're accumulating. I think they're still accumulating. I'm then taking a look at how other stocks are acting as well. So then stock gaps up on the earnings. So then having a quarter of the position left, I wish I had a little bit more, but it is what it is. I've now staggered my stop losses. So an eighth and an eighth. So I've put an eighth on the low, pretty much the low, just underneath $450, nice round number. So an eighth here at 44993, and then 1/8 here that will probably get moved up soon, but underneath the 21. Still looking to ride the 21. Maybe I keep this eighth back for the 50-day and see if I can go and ride like a really big trend like that with part of the position. Maybe this stock here pulls back down to the 10, the 21, and I have an opportunity to add to the position because it looks like a real leading stock at this moment in time. But that's how I'm then treating the position here. Now, for me, in terms of my selling rules, when I think a stock gets extended from the 10-day EMA, this is a strategy that I'll employ to optimize the profits. Again, optimize the profits both in terms of monetary gain but efficiency of the gain as well. So what am I doing? I'm going back and I'm studying the character and going, okay, when Meta has an earnings gap like this, okay, what's going to be a pretty efficient way to be managing part of the position? So you can see here, right, had you been in Meta, say like here or something like that, right? Maybe you had it there or here, whatever it may be, right? My point is that if you adjusted your stop loss to lower the bar, well, you would have been taken out here. Like, it's an efficient way to optimize profits when the stock gets extended from the 10-day EMA. If we fast forward again for Meta, okay, if I don't want to then hold it for a pullback, if I then want to choke it off and go just lower the bar there, I'd then be knocked out part of the position there. So it's similar, the earnings gap is similar to this in terms of characteristics of the candlestick. So then I'm looking to do that with part of the position. So again, I'm staggering stop losses. I'm doing what I think is optimal overall for the position. So it's not uncommon, and it's quite common for me to then start staggering stop losses as the trend starts playing out, and potentially keeping a stop loss back for a much bigger move like the 50-day. So initially I was going, okay, 10-day, 21-day, but as the trade is now playing out, potentially I want to keep an eighth back for the 50-day. Okay, trading is psychological as well. If you're then looking at a big gain in your account as well, and even though maybe you've only got a quarter or an eighth or a half of your position left, it makes you feel good. A lot of trading is trying to keep yourself here mentally in a right frame of mind to be taking advantage of opportunities when the market presents them to you. So that's how I'm then managing the position. So with Meta, I'm expecting it, yeah, maybe it kind of pops up for a couple of days, but then it's going to pull back to the 10 at least. Maybe it comes down to the 21-day EMA, then maybe there's a chance for me to then load back up in Meta. Or maybe there's a better opportunity in video, or whatever it may be. Again, I'm fluid, I'm adaptable. I'll wait and see what opportunities the market wants to provide. That's that Bayesian mentality. So I'll wrap the video up there, guys. Hopefully that gave you a real deep dive in terms of actually working for a trade, working through the 4 parts of a trade: identify, control, mitigate, and optimize. Really thinking about it on a deep level. Why are you doing what you're doing when you're doing it within the confines of your strategy? Nothing is random. Everything has a purpose. Every action in your trading should have a purpose. Why are you doing it? When are you doing it? Is it optimal? Is it optimal from an identification standpoint, from a controlling risk standpoint, from a risk mitigation standpoint, from an optimizing profit standpoint? So I really hope you guys have enjoyed this video. If you made it this far, I really do appreciate all of the support on the channel. So thank you very much for watching. Really hope you enjoy these deeper dive videos in terms of specific stocks and trades like this. Hopefully it gives you kind of a kind of view into my mind and how I think about trading and how I approach trading. So thank you for watching, and I will see you in a future video.